How we doing, everyone? My name is Will Holdren. I'm the host of the WillPower Podcast. Today we have an amazing entrepreneur who's helping the U.S. expansion for his company, and his name is Pater Maher. And Peter is the CEO of a company called Flote. And what they're doing is they're helping to lead the expansion in the U.S. and really just help build the next generation of payment platform from the ground up, which is an absolute honor to have him on here today. And Peter, in particular, has also been in this fintech space now for literally over a decade. So he's been around the block, seen a lot of things happen, and now he's helping lead the U.S. expansion for a whole company, which is absolutely awesome. So, Peter, first and foremost, thank you so much for joining me today.
Yeah, appreciate it, Will. I'm excited to be on and have a conversation.
Yeah, my pleasure. So you're obviously doing a lot of great things. You've been in the fintech space for a while, and I think that's a really interesting sector, especially with everything going on nowadays with AI and how fast the world is really changing. Obviously, a lot of the bigger entrepreneurs out there, some of them have started in fintech as well, like Elon Musk. You know, some of those guys. So it's exciting to dive into that industry. But starting out with you, I guess, how did you end up getting into this fintech space to begin with?
Yeah, so for me, it's how did I even get into business to begin with? It's a
Right.
wild story, but everybody has a unique path. When I started out in sales, it was not my intention to get into sales. It was just more so trying to pay my bills, and started out in construction sales and
Mm.
moved it over into payroll and HR sales. And then, when I was this would have been like 2013 maybe. I'd read an article that over 80% of the way in which a US company pays another US company was a hand signed paper check still.
Wow.
And it just, yeah, it kind of blew my mind. And so I immediately started searching for who are the companies trying to disrupt that, what's happening to disrupt it. And I got in to AP automation in the commercial card business. And from there it just took off and snowballed. I've always had my eye on consumer finance and the credit system. Um, to me, it's something that I think is very broken, and so I'm very passionate about anything that's disrupting it. Um,
Yeah.
so you fast forward, you know, I don't know what that would be now, 12 plus years.
12 years. Yeah.
Um, yeah, and here I am.
Gotcha. Well, I do love the sales background. It's kind of interesting that we've interviewed probably hundreds of entrepreneurs at this point, and the most successful ones I would say have started out in sales, like either one way or another, and just getting that understanding and getting that piece down. Because no matter what you end up doing, sales is always going to be a function of that company, of that business, and it really can help you build up resiliency. Starting early
Yeah.
out for you. So kind of walk me through the sales beginning for you. What were some of the main keys, main takeaways, main things that you've learned just throughout that process that you still kind of carry with you today with what you do now?
Yeah, I mean, sales to me, it's funny. It's one of those things where people that aren't in it tend to think that I would be good in sales, maybe because you can have a good conversation,
Yeah.
or they think it's mostly like whining and dining or entertaining clients. They don't realize the grind that people have to go through in order to be successful in sales, right? The reason, I would bet more than 90% of people that have started out in sales didn't finish their careers in sales or continue for very long
Yeah.
is because you have to have thick skin, or you have to learn to get thick skin. Um,
Yeah.
you know, Making the sale isn't the hard part. Having the conversation isn't the hard part. It's getting the conversation in the first place, right? So when I first started out, it was just about gamifying the grind, right? Paying attention to what others were doing that was working, learning how to get really thick skin and deal with rejection. Because it's not easy when you're calling on, the CFO or CEO or SVP of a company, and their assistant tells you the second they hear that it's a sales call, not interested, and hang up on you,
Yeah.
right? That rejection derails most people.
Yeah.
That person doesn't usually pick up the phone and try and call again or call somebody else immediately after. It's emotional, it's rejection, right? And so
Yeah.
learning to just deal with rejection at velocity. Um, And then the other thing I would say, my biggest key takeaway from just pure sales, right, was top performers. Anybody can be a top performer once,
Mm.
right? Anybody can have a good year. A little bit of luck combined with some work, but paying attention to the repeat top performers and what do they do, right? So um, not wasting your time, right? So a company might be a great fit if all the stars align, but have you done your research on that company or that person to figure out like, what's going on in their business at the time? What might actually be a priority that might take away from this? So making sure that you're wasting that effort or expending that effort on accounts that to the best of your ability you know are absolutely worth it.
Yeah.
And then treating a pipeline like it's always empty. Right. So I used to have a guy that worked for me at Capital One. Um, and his pipeline would get to a healthy place, but then he would always finish the year at like 70, 80%. And it was talking about the same deals every month. It's closing this month. It's closing this month. I'm sure of it. Rarely ever did. The thing that really got him to the next level was when he really adopted the mindset of like, you can't, there are a lot of circumstances with every deal that are out of your control, right? So always be feeding your pipeline with new deals, no matter how full you think it is.
Yeah.
Right. So if you can take a mindset that you're always approaching it as if you have no pipeline at all, um, then that's going to help out a ton when it comes to ensuring that, I used to call it the deal cloud for my reps, right? A
Yeah.
cloud rains when it's got so much water in it that it can't support it any further, right? And so
You want.
fill that cloud and make sure that it's raining every single month.
Yep. Yep. Just keep pushing and you can't get that complacency. I had a analogy done with one person who was
Yep.
talking to me about kind of a similar concept where he had a cup and started pouring water in the cup, right? He's like, this is what it's like building up your pipeline. You want to get the cup full, and then when the cup was full, you just kept on pouring. Because that's what you
Yep.
want to do. Just keep on pouring, keep getting
Keep
deeper,
pouring.
keep pouring, just keep pushing on because you never know what's gonna happen, around that next corner. So I
Yep.
think these are all really great points to bring up there. Um, and you also mentioned in particular how you got in the fintech space. You said 80% of companies were doing business by actually doing paper checks with one another back in 2013, which is insane. We always talk about too, like if you're an entrepreneur, like what industry can you disrupt and like what industry needs disrupting. And what you just mentioned shows that an industry like really needs to have disrupting at that time. So real quick, walk me through like what was going on at that point in the fintech space. Like was PayPal there? Was any of those other companies there? Or were you really kind of at the forefront of really everything that was going on at that point in time?
There were companies in the space at the time that were doing things around accounts payable automation and whatnot.
Yeah,
Um, but it was mostly banks that were trying to set up their customers to be able to, send ACH instead of check.
got it.
Not super innovative.
Yeah.
Maybe a little bit more automation and a little bit more digital, but not very disruptive.
Mm,
Um, to me, the companies that really disrupted that space and what I went all in on were the largest, call it like specialized credit card providers,
got it.
right? So you look at the first company I worked for in the space was a company called Comdata. Um, and then after that, shortly after that, Capital One, when I heard what they were doing, right? But
Okay.
basically, what they took is a corporate card that historically was a physical piece of plastic, something like you or I, if we were out for travel and expense or everyday business expenses, you use that to pay for it. At that time, the technology of virtual cards had come out fairly recently,
Hmm.
and that was the ability to issue a digital single use card on the spot, right?
Got it.
Um, so one of the things that companies were doing to really speed up that process is, and Capital One, in my eyes, was not the first to enter, but they paid attention to what others were doing and they took over very, very quickly.
Hmm.
We took over very, very quickly, and it was but they're like, okay, what can we do with this technology instead of it just being for travel and expense? What if we could issue an unlimited amount of virtual cards simultaneously at once and then enable a merchant or a business to pay their vendors who accept credit card using a single use virtual card? And they're getting cash back on it because it operates on the credit card rails and there's interchange, right? And so when I looked at that, it was like, holy cow, if a company has, 1,000 merchants that they're paying on a monthly basis, or 1,000 vendors that they're paying on a monthly basis, and they can issue, and 300 of them accept credit cards, right? Then they can issue 300 single-use virtual cards instead of writing them a check. It's highly secure. You don't have to worry about fraud. One, and then not only that, the company can generate cash back on what was just legacy costs going out the door,
Right.
right? So suddenly they're taking their accounts payable, which is their largest, next to their payroll, often their largest cost center, and they're actually turning it into a revenue generator. And they're making their AP process 30% quicker in that scenario, 30% more secure, and the sort of reporting and reconciliation and everything that comes along with that being a digital payment method now tied to a card system is amazing. So to me, that was kind of like the first foray into the ones that were actually like doing something to change that process. Whereas the banks and such in the past had historically just been like, well, if you don't want to write a check, do an ACH, but it didn't create any efficiency. It didn't create any revenue.
Yeah.
Um, so that was what excited me. So that was where I chose to go all in at first was on the commercial card side.
Gotcha. Yeah, I can see how it can be a big swing, especially like you said, how, a lot of times you're sending out the check, you're not getting any money back by doing that. And if you can find a way
Yep.
to generate even like a few percentage points back on no matter what that expense is, I think that's a big deal. It's a lot of big numbers when you get into bigger numbers for these bigger companies and how much they're sending out, each month.
Yep. Yep. And there was, and the check, for every check that you mailed out, you were also mailing out your bank account and routing number, right? So fraud was huge.
Right.
So every one of those that we could take out of the system was a value add in itself.
Gotcha. And you said like in the hypothetical scenario, like about 300 of those merchants would be able to take in like credit cards and not all 1,000 of them. That to me seems crazy, but I guess at the time that makes sense, right?
Yeah, well, and just like any other business, it was highly dependent on the verticals that you were focusing and targeting after.
Yeah.
There were certain industries like manufacturing where good luck putting your AP on card. There were other ones around healthcare costs and construction where they just want to get paid. They don't care if it's a card or a check.
Yeah.
Right. So it was being thoughtful with where you were trying to deploy those services. But yeah,
Mm.
we would have, I mean, we had some companies that were able to get 50% plus of their
Wow.
vendors onto a card.
Wow. That's pretty interesting. That's definitely like a market change though, right? So that's the
Yeah.
kind of stuff you want to do. So walk me through real quick what you guys are doing now with Ovanti now became Flote, and really what are you guys trying to bring on into the US marketplace with Flote right now?
Yeah. So ultra high level. The couple of years that before I came over to do this, I was leading go-to-market and partnerships for a buy now, pay later, one of the big four ones. And essentially, in my time there, I loved it. It was a great company. They had figured out a way to take the BNPL service and offer it to some customers that maybe had lower credit scores or were deemed higher credit risk by the compared to other models.
Hmm.
But what I also realized there is that they're all kind of built on the same model and system, right? Pretty much owned by their bank or controlled by their bank. Um,
Yeah.
they're using bureau data and soft credit checks. So even though it doesn't hit your credit score when they approve you, they use your credit data to approve you or decline you. Um, and there were a lot of good customers getting lost in the funnel because they had bad data or inconsistent data across the bureaus. Maybe they had moved addresses multiple times. Maybe they switched phone numbers. Maybe they're on a lease that was under somebody else's name, and they would get kicked out in ID verification and such.
Wow.
Um,
Yeah.
but the reality is, BNPL came to the US sort of as a promise and an alternative payment method to enable customers who maybe don't have access to credit to be able to purchase something and spread it out over a few manageable payments. Um, and while it did that to an extent, um, it's really evolved more into traditional credit offering. Whether or not they report to the bureaus, it's still a loan, it's still debt. Um, and so you have call it like the designer brand BNPLs, like the Klarnas, that they're trying to get people from I always say a Coach into a Louis Vuitton or
Mm.
something a little bit maybe outside of their affordability,
Yeah.
but becomes affordable because they can spread it out over a few payments. But in their model, they can't go very deep in credit scores, right? Because they're still giving out higher dollar amounts over short periods of time. The bank won't let them take on the risk, to be able to do that and approve it to a deep subprime credit score.
Yeah.
Then you have other providers that have done great job of going deeper on the credit score into the 500s or low 600s with approvals. But the reality is you're only getting a couple $100 tops,
Mhm.
right? So um, but to me, it's like credit score is not an indicator of affordability. And I think just about everybody agrees with it. You look at any merchant across any category, and 30 to 50% of their payments are debit or cash. For the most part, that's not because that's the consumer's preferred payment method. It's the only one that they have access to, unless they want to go to like payday lending or some lease-to-own providers. So what we've built here and what we're launching in the US as Flote is an entirely open banking, cash flow, affordability driven decisioning engine. We don't pull in any credit scoring, we don't pull in any bureau data, and it's based off of what you can actually afford based on your current cash flow circumstance, right?
Interesting.
So it enables, you look in the US, you've got over 150 million people when you combine the populations of people with consistent credit history, but subprime or deep subprime credit scores, 620s and below. You've got well over 10 million, 20 million gig workers. These are Uber drivers, Lyft drivers, freelance creatives, photographers, marketers, copywriters, you name it. You've got the 18 to 25-year-olds that are new to credit or establishing credit. And then you've just got the credit averse, which are people that grew up in households of high interest revolving debt, have heard the horror stories, and they don't want to be in debt,
Yeah.
right? What we can do is approve in that within that population, which is over half of all adults in the US, kind of scary. But essentially, we can take a look via open banking data at their linked financial institution and say, hey, what can you reasonably afford to have as a payment at any given time? And then we enable them to make a transaction. And then we can do things like align their due dates to be payday plus one if they have consistent pay dates. So
Interesting.
essentially, what we're trying to do is enable that debit and cash first consumer that makes 30 to 50% of all the transactions. We're trying to enable them to spread that out a little bit.
Gotcha.
Um,
Gotcha.
yep.
Yeah, I think that's a really interesting concept, not going based off your credit score, which to your point is not like a true, factor of like what you can afford or not. But the real factor is cash flow, right? Because you could have a new situation pop up, or now you got a whole lot more cash flow coming, and now you can't afford these payments of whatever it is to go out and buy that item on credit. I think that is very unique.
Yep.
I'm kind of curious. So with that model, I mean, obviously there's probably a lot of concerns around that, but I guess a few of them just thinking out loud now is like, what if someone is someone who generates cash flow, but I guess spends it very quickly the next day? Like you're saying that you guys would bill them like the day you get paid, and the next day after that, that's when you actually go and collect the money to pay off some kind of credit. But some scenarios where people just get money and spend it faster than they get it, at the end of the day. So yeah, we've seen that pop.
Yeah, and we want to help people with that. So when we're using open banking data and through our partners, essentially we'll be able to surface things like how are you comparing to peers that are in similar cash flow situations as you?
Yeah,
What are some categories you could shop at that might actually like help you spread out your cash, or maybe we can make insightful recommendations on like, hey, maybe you should slow it down a little bit over here.
yeah,
Right. And so it goes beyond BNPL, but more into like financial wellness, budgeting, cash flow management.
yeah,
There's going to be bad actors out there, and our job is to minimize the risk.
yeah,
Um, but we'll look at a gig worker, or we'll look at an employee, or we'll look at a student, and we'll just say we'll make a proposed payment plan based on their cash flow cycle.
yeah,
Um, the reality is, if somebody misses a payment with us, or if they don't pay us back, they lose access to our service until they do. But we want to work with people, right? We want to create a product that helps people avoid the everyday financial bottlenecks. And so if somebody's has a strain coming up or needs to pause a due date or skip, or we can do that.
yeah. Yeah, gotcha. I guess real quick too, for those listening, last thing that I would like to say, if people want to reach out to you, what's the best way for them to contact you? Um, yeah, and also, yeah, what's the best way to get more information about what you guys do?
Yeah, well, they're more than welcome to reach out to me on LinkedIn, Pater Maher, Maher, but also peter.m@ovanti.com or peter.m at flote.com, Flote.
Gotcha.
But yeah, anybody can reach out. I'm always happy to chat.
Awesome. All right, guys, there you have it. Peter Maher, thank you so much for joining me today.
Thank you. Cheers, Will.
Have a good one.